This video was made for you. No fluff, no hype, just clarity. This is the ultimate 6-minute Forex beginner guide. In the next 6 minutes, I'll cover all the essentials. What is Forex? Currency pairs, how trading works, charts, strategies, risk management, brokers and accounts, common mistakes and how to get started. Let's dive in. First, what is Forex? So Forex stands for foreign exchange. Basically, it's a global marketplace where currencies are traded. Now you might ask, why do countries trade currencies? Well, imagine you're importing lots of stuff from other countries. You're going to need their currencies to pay for those imports. So that's where the foreign exchange comes in. Countries buy and sell currencies to get what they need for international trade. But how does Forex work exactly? So it's simple. You're always buying one currency while selling another. For example, EUR, USD. That means you're buying euros while selling US dollars. So let's say the euro strengthens against the dollar. Then your trade will be profitable because you bought low and sold high. Profit. But if the euro weakens against the dollar, well then you guessed it, your trade will be a loss. Next, let's talk about currency pairs. Currency pairs are made of two letters or two letters and a number. As I mentioned earlier, your USD is the most popular pair. You can see there are thousands of pairs out there, but stick to the major pairs when starting out. Major pairs are the most stable and liquid. They include your USD, GBP, USD, AUD, USD, NZD, USD, USD, JPY, and USD CHF. Minor pairs are next in stability, followed by exotic pairs. Now a quick note about time zones. Some currency pairs have different time zones. Like GBP USD involves the British pound and the US dollar. So it's affected by both the European and American economic calendars. On the other hand, AUD NZD is totally unaffected by any major time zone events since both currencies are from Oceania. Moving on. Let's explore how trading actually works. So you're going to use a trading platform like MetaTrader or TradingView. Let me explain. Say you want to trade EUR USD. You open a position by clicking on the bid price. When you click it, you're buying the euro. Click on the ask price, you're selling the euro. And the difference between the buy and sell price is called the spread. Brokers make money from that spread. There are two ways to make money in Forex. The first is through the spread. The more volume you trade, the more money your broker makes, and thus the less money you make. The second is through commissions. If you take a trade and it moves 10 pips in your favor, you'll make money. So here's an example. If you buy one standard lot of EUR USD at 1.1000 and the price goes up to 1.10100, you will make 10 pips times one standard lot. That equals $10, but be careful. If the price moves against you, you could also lose money. But hey, that's part of the game. Next, let's chat about charts, time frames, and strategies. So charts help you visualize how the market has been moving over time. They're super useful for spotting trends and making informed trading decisions. Let's break down some key terms. First, candlesticks. They're those colorful things on the chart showing price movements over a specific period. Each candle has a body and wicks. The body represents the price range during a specific time frame, while the wicks show the price extremes. Time frame is basically the length of each candle. It's like how long you want to look back on to see how the price has been trending. Popular time frames include 1 minute, 15 minutes, 1 hour, and 4 hours. Each time frame gives a different perspective. Let's quickly go over some basic strategies. Support and resistance levels are like the floor and ceiling of a room. Keep the price from going below or above a certain level. Prices tend to bounce off these levels, and we have trend following. This strategy is like surfing. You ride the wave of a trend until it ends. Moving averages can help spot trends, and there are breakouts. Imagine the price breaking through a resistance level. That could be a signal of a new trend. Finally, candlestick patterns like dojis or engulfing candles can give insights into potential price movements. Remember, you don't need to learn them all. Pick one style and master it. Now, risk management is super important. Don't ever risk more than 1% to 2% per trade. Imagine you have $1,000 in your account. Shouldn't risk more than $20 per trade. Set a stop loss to limit your maximum loss and always know your risk to reward ratio, at least 1 to 2. Trading without risk rules is gambling. Trading with risk rules is a skill. Speaking of skills, did you know that top traders spend countless hours honing their craft before diving into the deep end of live trading? Similarly, if you want to become a pro in the financial markets, it's crucial to practice and refine your strategies before risking real money. That's where our platform comes in, the virtual $1 million to play with. You can experience the thrill of trading with real-time market data without any financial risk. Plus, with no commission fees, you can test out different strategies and maximize your virtual profits. And the best part, you can compete with other traders and win exciting prizes. So why wait? Sign up today and take your trading to the next level. All right, let's move on. Next chapter, brokers, accounts, and tools. To start trading, you need a regulated broker, a demo account, MetaTrader, 4 or 5. TradingView or your broker's app, a news calendar, journaling system, and screeners. With a demo account, you can practice risk-free with virtual money. And if you don't feel confident enough, you can keep practicing on the demo account. Here's a quick summary of everything I covered. Now let's address a big question. Is Forex trading a scam? Well, it's not a scam, but there are plenty of scammers out there. Avoid those unreliable brokers that promise super high returns or use dodgy websites. Stick to reputable brokers. Next, let's discuss some common beginner mistakes. The first mistake is over-leveraging. Don't put all your eggs in one basket. Don't risk more than 1 to 2% per trade. Second, trading without a plan. It's like driving without a GPS. You're more likely to get lost. Third, revenge trading after losses. It never works. Fourth, ignoring the news. Economic news can cause big price jumps. Be prepared. And fifth, switching strategies too often. Focus on mastering one strategy before moving to another. Remember, most people lose not because of a bad strategy, but because of bad discipline. Finally, let's talk about how to get started. Choose a reliable broker. Open a demo account, download MetaTrader or TradingView. Practice on the demo account until you're confident. Start small with a live account. Follow the risk management rules I shared. Keep learning and stay disciplined. So there you have it, the ultimate 6-minute Forex guide. Remember, your first job is not to make money. It's not to lose money. Take it slow, take it easy, and enjoy the journey. If you found this helpful, comment Forex Start below. Stay tuned for more.